Welcome to the Dividend Talk podcast, episode 237, Surviving Currency Risks. Hola, EDGI. Me ha gustado tu podcast con Alberto.
Thank you.
I enjoyed your podcast last week with Alberto. I have to say he did really well standing in for me. I did get all the jokes that you passed my way. I listened to
Which jokes?
most of them. But it was a good podcast, and 2 hours. Wow, you guys had a lot to say.
Yeah, we were just talking about consumer staples. I mean, we when we finished, we said we can talk another 2 hours, but we didn't want to bore our listeners too much, right? But that's the thing, he's like a book of knowledge.
Yes.
Yeah. And I also know a lot about those companies. And the nice thing was about it was that on some stocks we had totally different views. Yeah, where he was mostly looking into the operating margin or something like that, and justifying because of that the strength of the company. Where I was more looking, for instance, I don't know, at the balance sheet, let's say. Yeah, but that made it so interesting, also insightful for me, because I don't learn from people that all the time think the same. Yeah, I learn from people that challenge my thinking. You did it often, but after 2 years, you start. 4 years, 5 years, you start growing to each other, right? You start kind of developing the same mindset. So for me, it was also really nice to talk to Alberto a little bit, because it's challenging and thinking is so nice for me. Also on the Facebook group that we also often have it. In Twitter, is a bit of a different story. In Twitter, there are too many people that know it all. Yeah. But on Facebook is a little bit more humble in our group. And I like that. Yeah. And this challenging is needed, because that's how we become better investors. You're kind of a worst investor if you never listen to others, if you don't listen to other input. Because if you get input that challenges your thesis, you can really make a decision like, okay, what do I do with that information? And it really requires you to be accountable about your judgment and try to be objective. So I often have this approach like, okay, when I believe this, but if someone gives me a knockout argument, I can switch my opinion in a day, yeah, or in a split second, yeah. And but I know it's sometimes hard, because often we are psychologically anchored to our belief system, to the share price. Psychology is the biggest issue, and that's why I always push myself to listen when others speak.
Yeah.
And it's hard sometimes. Yeah, it's hard sometimes. But with Alberto, it was really easy, because he's just a book of knowledge, a walking encyclopedia. And I hope we can interact a bit more with him on and off the podcast. He has a bit of a busy time in his life now, but yeah, he shouldn't be hidden somewhere, because he's not so active on social media, he told me.
Yeah.
He shouldn't be lost for the community, right? They did amazing job with Carta del Dividendo as well. I mean, the community they built there in Spain. It must be such a pity for their Spanish listeners that they can't have this anymore. So
yeah. I was gutted I missed the podcast, because we had Alberto on before, and as you said, an absolute encyclopedia, some great insights, and knows a hell of a lot about consumer staples. It's like his bread and butter. I would have liked him to talk to him about Coca-Cola. Remember, we were going backwards and forwards about that one. But yeah, great podcast.
Yeah, maybe Eloy, we should also ask him.
Yes.
Is partner in crime, let's say. So let's see if you want to.
Let's move on to some news of this week, and let's give a huge shout out to Sipo on our Facebook group, who has reached the status of retiring early. Man, that must feel incredible. He wrote a nice little post on it about how he retired, handed in his notice, and he's gone from his job about a month. And he gave a little detail behind that, but yeah, what a feeling that must be.
Yeah, and then what I liked also is that he had the courage, because he was building his wealth on the Mac 7, and then he mentioned kind of that he also started listening to the podcast. And I don't know if the podcast was inspiring him to move into dividend investing. Probably he made the decision before. Maybe the podcast has helped a little bit in his conviction or in the approach. But he transitioned his portfolio in dividend stocks, and now he's having like 35,000 euros in dividends each year. Yeah, by transferring this all, and that's just amazing. It's really amazing. I mean, it requires courage, right, to sell your portfolio, your holdings that been like an Amazon that has been, I don't know, tripling, quadrupling, whatever. Yeah, and then put it into boring dividend stocks. I don't think that is easy. So kudos to him, and I really hope he enjoys his retirement. I mean, maybe he should come on the podcast one time and effectively explain his journey, because I would be really interested to get like a look into his brains. Like, how did he do this? The selling the Amazon, like in that moment, how do you feel? Like, okay, yeah, you press the button, but come on, that must have been a thought process, right? So I would really love to have him on one time.
Yeah. We spoke about this before when we had, was it Wolf of Harcourt Street or somebody, how the psychology of having a growth mindset and changing at the last moment would be difficult for me personally.
Yeah.
So it's so interesting to see someone who's actually done this successfully. And I wonder what that psychology and how you make that switch and how you feel doing that, especially because there's been times when those Mag 7 have grown significantly over the last 5 years. So has he ever been kind of wanted to go back the way? Has he been just happy with dividends? But there's so many questions.
Yeah, exactly.
Yeah. Now we look at the news. I mean, I don't know. I'm struggling to go on Twitter and X and all these news, because all I'm seeing is Trump and tariffs and Trump and war and Trump and Trump and Trump. And it's no surprise we got a load of questions. We got a question from Connor. Are you more cautious about investing in the US, given this clown has smashed into the Oval Office? Richard is asking us about being cautious in the Canadian stocks, because we know the US and Canadian are like brother and sister fighting right now. And ETFR has asked us, have you been in buying mode as Trump has made the stock market pretty volatile? I mean, there's a lot going on, isn't there? And what are your thoughts on it? Has it affected you? Are you buying more? Are you buying less? Are you just sitting back?
I'm just doing what I'm always doing. And Ron, please listen. I've been euro cost averaging. He asked me like, why are you talking about dollar cost averaging when you're like European? Why is it not like euro cost averaging or zloty cost averaging? And he is right.
He's right.
We should be a little bit European patriotic like that. So from now on, let's try to not use DCA, but ECA. And yeah, let's hold each other accountable for really using this term going forward.
We'll do our best.
But look, I was just wondering, right? Like, I'm sure that he will not put a tariff on L'Oreal, because then his orange schmink will be much more expensive. Yeah. So, and I've got shares in L'Oreal, so with that one I should be fine. But no, I mean, clearly there's geopolitically so much going on. I mean, also like whether it's defense stocks, right? The 800 billion aspiration that van der Leyen announced as well, to prepare Europe better, right? From a defense point of view. Then in Poland today, I read some news, and thanks also Brandon for highlighting it to me, that by the end of the year, the Polish government wants to have plans in place to give every, I think, adult citizen military training, and they want to get from 200,000 military force to 500,000 effectively. Yeah. Very soon. So I mean, those are a little bit like, not such a pleasant thoughts. Yeah, it comes really close then, and such. So when I look at all of this, I just wonder, like, oh my God, like only this needs to happen, and all escalates, right? And yeah, and then you have the tariffs. I mean, what can I say? I don't really understand the politics behind it. I mean, I understand it economically, but I don't understand the political reason entirely behind it. So I guess I read somewhere that if you really want to understand it, is that in 2025, the US government, so later this year, they may need to pay a lot of interest on debt, yeah, or in the next year. So they will benefit a lot from lower interest rates. Now, with lower interest rates, you need to drop inflation. How do you drop inflation? You get the economic recession or something like that, yeah? So I don't know if this is by design, but I think we give them people too much credit for this. I just know it's a shit show. It created a lot of volatility, and I like volatility because you get buying opportunities. So that's really how I look at it. I mean, these are the kinds of things you can't control. I mean, I'm not in the White House. I'm neither in Europe, so I can't control any of this. My portfolio has always been designed in mind to not have too much dependency on a single entity, whether it's a single stock, a single sector, a single country, a single currency. It's been designed like that. Yeah. So in my case, my portfolio went up this week. And even more interestingly, because the currency changed 5%. Yeah, from 1.3 to 1.8.
Yeah.
So, and my portfolio went up. Of course, there was a bit of buying there. That's part of it as well. But generally speaking, I mean, for me, it was a good week, a really good week.
Yeah. Yeah. But you have to remember, if you have a long-term view, Trump is only going to be in office for 4 years. That's it.
Yeah.
I mean, so it creates, as you said, buying opportunities with all this volatility. We have companies like Target that are dropping. There's probably some Canadian companies that are dropping because of this. So if you have a long-term view, forget about Trump in the office and focus on fundamentals and you should be fine. But I don't know. I think he's gone crazy. I think he's gone absolutely crazy because he's talking about Ukraine. He's talking about attacking Russia. He's talking about Canada. He's talking about China. He's attacking everybody at the same time. It just seems insane what he's doing.
Yeah. But, first of all, I'm for sure not a Trump supporter at all. Yeah. But let's counterbalance that argument a little bit. We have been letting Ukraine kind of suffering on its own now for 2-3 years. Yes, we've been supporting here and there a little bit. But why is Europe suddenly so united in defense? Yeah, we've been like boiling frogs under the wings of America. So it's kind of okay for me that Europe starts to unite a little bit and have a bit of a voice and starts to take a little bit of accountability and ownership over our own land as well. And, I always like to think about this quote of, I don't know who was, maybe Einstein, but like, if you try something for the third time in the same way and you expect it to change, but of course it doesn't. That's kind of the definition of an idiot.
Yeah.
So it is of course quite risky what Trump is doing, but as someone that studies economy and financial markets, to have a economic dependency on a certain land like Ukraine with what they want to do with minerals, yeah, that's always when you had American support. Why do you think America was also in Iraq and Afghanistan? I mean, again, I'm not in geopolitics, but there was oil there. Yeah. So all I'm trying to say is like, maybe this is a way forward, right? At least how it was going, I was not happy with that because Ukraine was kind of on its own. There was not really support. I mean, there was support from Europe, don't get me wrong, and we shouldn't discount it to zero. But I'm much more happy with the messaging that I hear over the last weeks, that we really start to build up a little bit our own stuff again in Europe. Yeah. And don't just watch to America and hope that they will do something for us.
Yeah.
I mean, but this is the reality that has changed, right?
Yeah, of course. But hey, that's enough about politics for now. Let's talk about what we talk about in dividends. We've got some nice dividend announcements. Reckitt and Benckiser hiked their full year dividend by 5%. Now the CEO left and went to Starbucks, and now they start hiking their dividend. So maybe that's no coincidence. Thales, a popular defense stock, hiked its dividend by 8.8%, which you could probably expect. Lindt and Sprungly hikes their dividend by 7.1%. Greggs hiked their dividend by 11.3%. Also, their share price dropped significantly after that. Deutsche Post keeps its dividend flat. And one that we missed is Munch on Machine, Mana Machine. They hiked their dividend by 12%.
You own that one, right?
Yes, so I have Greggs and I have Munch on Machine.
Oh my God, how many double-digit hikes did you have this year? Unbelievable.
I'm on about 6 or 7. I had BAM, these two. I can't remember.
And then you had NN Group and ASR with 8% on high yield.
Yes, yeah, it's been a pretty good year in terms of dividend hikes.
Oh man,
Just once there's no dividend cuts. Enegas, it was last year. I don't want any cuts this year. That's the goal. No dividend cuts. There was one dividend cut this week, and that's IMCD. They cut their dividend from 2.24 to 2.15 per share. Not a company I own. So
No, but I mean, it's a dividend cut, but oh my God, why would you cut the dividend like that with 9 cents? Just give them that. I mean, insane.
Yeah. Management. It feels like a Siemens cut. Remember that or Danone.
Yeah, but Siemens cut was because of a spin-off of Siemens Energy. Danone was such a nasty one as well, with 20 cents or something like that. I mean, then that's just like you want to irritate your shareholders, right? It already starts working on me. When I see this, like a 9-cent dividend cut on 2.24, I feel like, come on, CEO, let's have a conversation in the pub and let's do some arm pressing, because this is insane. Why would you do a 9%? I mean, are these like these MAFO feels or something like that? That if you're like, no, 40% payout ratio is a 40% payout ratio. No, we're not going to do 42%.
That's exactly what it feels like. So, look, who knows?
It's like a neurodiverse friendly company then.
Yeah. So, surviving currency risks. And we spoke about this a little bit earlier. We know the US is in a little bit of, I wouldn't say turmoil, but there's a lot of volatility there. But it creates buying opportunities for us. But as part of that, our portfolios can fluctuate, both in value, because we have lots of US companies, but also our dividend income can be less. So why does currency matter for investors, and particularly European investors?
Well, I think if you're really simple, if you're investing in US dividend stocks, there are two things. When the dollar becomes stronger, you can buy less ownership in the US company that you want compared to before, but your dividend income increases. And like this week, if the dollar becomes weaker, you can buy more ownership, but your dividend income decreases. And that's what we're experiencing this week, of course. So there's definitely fluctuation. And if you're 100% in US stocks, it must have been a tough week, because suddenly your dividend income decreased by 5%.
Yeah, right off the bat. I mean, if you're not a dividend investor, quite obvious you would want the weaker dollar, because you can buy a lot more of those companies.
Yes.
But it's dividend investors who get punished. But it's a bit of a tough one, isn't it? Because we're kind of in the phase where you're still accumulating. So you want to buy more shares.
Exactly.
So you want the weak dollar.
I'm happy with it.
But I also track my dividend income, and I like to see that growing. And if it's not growing because of currency, it's kind of like a...
No, but I like more that I can buy more ownership in the company. Yeah, definitely. I mean, when I started in 2014, I believe, it was like 140.
Yeah, I remember that.
Can you imagine that you would be on a 140 now? I mean, damn, how much you could... That's like a 30%, 35% difference compared to now. You got like a third more almost, or fourth more in stock for that. I mean, those were good times. So also, I think you need to take this a bit with a grain of salt. Yeah, last year it was also 110. So, I mean, yes, there's some more volatility this week, but if you zoom out a little bit, not a lot has changed, right? Whether it's been going between 1 and 110 for how long? A few years now? Yeah. So,
yeah, I remember going for my honeymoon actually in 2014, 15, and it was close to 1.5. So when I was converting over to US dollars, I was getting a lot of money.
Exactly. And I wouldn't mind if it does that over the next 2 years, that it goes to 150 and that it kind of anchors there. Yeah, I really wouldn't mind.
Yeah. But then Europeans, then we get this a lot. How should they mitigate against this risk? There's a couple of ways.
Yeah. So there are a few things that you can do. One of them is, of course, just diversify your portfolio in different currencies. And that's something that I have done. And I have done that always by design, because I've always seen the currency risk as the biggest risk. Although I live in Poland, my portfolio is like Euro domiciled, as I would call it. because that's kind of where I see the future for me and my portfolio. And if I think about the currency distribution, look, my USD holdings, right? So value, not dividend, is 48.4% in dollar. In euros, it's 32.6%. And then I've got British pounds, 8%, Swiss franc, also a little bit, and Swedish crowns for 3 point something percent. Yeah, and then I still have a few other currencies. So it's less than half the US dollar. And for me, that's quite okay because it kind of reflects of the strength. No, it kind of reflects the dividend universe. If you think about dividend growth stocks, the majority is in the States. And then with the other countries, you can kind of find the other half. So that's one of how I do it. And also at this moment in time, for instance, if you're really afraid of the currency, I would just say try to buy more in your own currency so that you avoid having this risk. But what people should not think is like, oh, you know what? I'll now buy Johnson & Johnson in German stock exchange because I buy it in euros. Yeah, no, that's not how it works, unfortunately, because it's still connected to the USD, and the currency risk is then just in the share price.
Yeah, and you're probably paying in fees probably more for that company. But I mean, as Europeans, we can invest in plenty of companies that have lots of US exposure, if that's what you're looking for. It doesn't
then you pass it on to the company.
Yeah, exactly. So like think of Ahold Delhaize.
Yeah.
SAP, for example, which is one, LVMH, ASML. So there's plenty of companies within Europe that would give us that kind of exposure. But I suppose the difference is the dividend policies.
Yeah.
European companies tend to pay from earnings, tend to slow down, whereas American companies, they don't have defined dividend policies, but they usually grow them a lot better than European companies. So
and based on that also, right, when you think about Ahold, there you have like people whose day job is to work in the treasury department.
Yes.
And it's their day job. And I don't know if Ahold does it. I would need to read the annual report, but it's probably to hedge against currency risk. I mean, surely Unilever does this, yeah?
Yeah.
So it's their day job, and those are professionals. We are not. So it's a bit easier for them to hedge because we can also hedge, yeah? We can also buy those kinds of currency hedges, but it comes at a cost. And you need to have a feeling for the direction that the currency is developing. Yeah. Well, the direction was all the time to dollar parity, and here we are. It's now 1.8. Yeah. How easy was that to predict?
Yeah, I'm not sure what the statistic is off the top of my head, but I know if you go on to any of those FX brokers, they give you that warning, and it's something like 97% of investors lose money on foreign exchange. So that would tell you how hard that is to do.
Yeah.
So for me, that would be very, very risky and very dangerous.
Yeah, I think this is really where I would say like that's for me more of the professional investors, hedging your portfolio like that's. Although I have my papers, I see that is not my circle of competence, because then you really need to go into all that stuff and we're just simple buy and hold investors in the end.
I think if you want to go down the hedging route, you can buy some ETFs that do this. So the iShares S&P 500 hedged ETF, for example, I would imagine they're higher fees. You have to pay for this hedging somewhere along the line. So it would be higher fees, but it would give you a little bit of hedging that you don't have to manage. You have an ETF.
And you're not investing in dividend stocks anymore. You're just investing in the broader stock market, in the S&P 500 as an example.
Yes, exactly. And would you ever consider I know we both have interactive brokers, but having just a USD holding for your US stocks and then a European with euros for your European stocks? Would that ever cross your mind?
But I just buy my stocks on the local currency, local stock exchange where they are. So they are already in that currency. And then it just calculates what my portfolio currency value is based on my local currency. So for me, it's in zlotys. Yeah. So, I mean, it's already in euro, it's in USD. I've got all these cash accounts as well. So I've got cash in Great British pounds, I've got cash in dollars, and I've got cash in euros and cash in zlotys at interactive brokers. So I have those four balances, and that comes from the dividends that I paid there as well. And my holdings are in their native currency because of the stock exchanges where I buy them. So for me, it is already like that. Like what I did when the war in Ukraine broke out, there was a strong response in the Polish zloty, and then I bought some dollars, a few thousand, for that reason, because I didn't know where the zloty would go at that moment in time. But generally speaking, I would not, let's say, transfer. So let's imagine, in my case or in your case, it would be euros. But in my case, I transfer, let's say, 10,000 zloty to Interactive Brokers. That is like, okay, and then that will be on the account. Then I'm not the person that buys then dollars, I don't know, for $2,500, puts it on the dollar account, and then buy US dollar stocks. No, I just buy straight away from the zlotys. I buy the US dollar stocks as such, and it works like that. The same as at the hero, right? That it does it for you. So I'm not the person that first goes directly into the dollars.
Yeah, I know that Interactive Brokers does that for me as well. But sometimes you notice the USD, it fluctuates quite a lot, and it can affect your balance. I never really. I know some people transfer it back over to euro. I just let it ride. Yeah. So, I mean, I don't think there's many other ways to mitigate against the risk. It's a risk that we all have as Europeans. So I think if you're really, really worried about it, the best thing to do is just to own more European stocks. I think that's probably the safest strategy if you're worried about risks.
But then your stock universe that you select from is smaller, and that may increase again a risk. I mean, this is why how you said, this is what investing is about. If people are afraid, they should just put it on their bank account, but they will miss out on the economic wealth creation that all these stocks in the stock universe are doing. Yeah. So again, it sounds maybe really like a broken record, but just euro cost averaging, making sure that you diversify a little bit. If currency is an issue for you, I mean, I feel very comfortable with almost 50% in USD and the rest in euros and others. I feel very comfortable with that. It's like 50-50. I mean, today it's the USD, maybe tomorrow it's the euro. You don't know where it will play out. At least I don't know. I'm not a Nostradamus. I don't study macroeconomics too much because I prefer to study company reports. Yeah, and there's opportunity cost in time where you want to spend your time. Yeah, and I think we get mostly afraid because of these things, because it's maybe in the news about the dollar and such, if you put CNBC on or whatever channel. And I think, it plugs information in your head, and you probably start thinking about that. It's not the first time, I mean, that something happened. Remember, it went from when I started investing, you just mentioned 1.5. I was around 140. It went at a certain moment to dollar parity. Now it's again back to 1.8. The only thing I've been doing is just always buying shares. Just like I get my salary, 50% straight to my broker. I deploy it in that month, and you're then euro cost averaging.
Yeah. And now that you know the USD is weaker, are you more biased to buying US companies right now?
No, I'm just buying what I want to buy.
Yeah, it doesn't influence you at all.
No, not at all. So I bought a US stock this week, and I bought a British stock this week, and I bought a Euro stock this week. So, and it was not because of the currency. It was just because I had them on my radar, and that's why I bought them.
Nice. Yeah, I think.
And how about you? Does it influence you at all?
No. I don't even look at the exchange price at all when I'm looking at it. It doesn't even come into my mind. But as I said, I was looking at my portfolio this week, and I checked it Monday, and it was at like, I don't know, 118,000, and it dropped to 113. I was doing a portfolio review, and it just dropped, and I was like, man, this is crazy. It's a lot of money in a short amount of time. But yeah, I mean, I always expect this thing to average out over time. Sometimes you buy when it's lower, sometimes you buy when it's higher.
Exactly. It is like food shopping. Yeah, you all want a discount in the supermarket, but if you need to buy a bottle of water, are you going to wait 6 weeks before the bottle of water is in discount? No, you need the water. You just buy it.
Yeah.
Yeah.
And honestly, if I thought I knew how currency was going to react, I would just become an FX trader and I'd be part of that 3% that make money.
Exactly, exactly. And you will be a billionaire with those fancy sport cars and do TikTok videos about how everyone else is stupid.
Yeah, and sell courses and so on and so on. Yeah.
Exactly. Now, I think it's maybe, we get these questions, and it's probably a very boring answer that we are giving, but there's really no fireworks in what we do. It's just like I mean, I love the stock market and the volatility right now. That's for me really popcorn, right? To see this all happening. But for me, it's like I'm in the cinema and watching an action movie. But under that, I'm just chill and just buying what I'm always doing.
Yeah. Okay, I don't think we have much more to say on currency risk.
Not at all.
It doesn't, but it does come up quite a lot. So I thought it was interesting to speak about. But we do have quite a lot of listeners' questions, so we will go straight into those. And JVDK has asked, right, for a Dutch guy like himself, how much change do you have to get back from foreign dividend tax? And is it best to do it yourself or getting an accountant?
Yeah, this is very tricky for us, right? First of all, not so many brokers give you for free a dividend check, a dividend voucher, right? So sometimes you need to pay per line item, I don't know, 120 euros, $150. So it's really not cheap. You need to do this sometimes because not every foreign government accepts your statements. So they really want to see the dividend checks. And it's a lengthy process. I believe one of our community members from Germany or from Denmark may be already waiting for 2 or more years. Yeah. So it is just really, really difficult here. And should an accountant do it? I don't think so. I think you can do this yourself. It's just really like read the form and fill it in. It's not too difficult from that point of view. It's just like cross your fingers and hope that there's a clerk on the other end that is not too grumpy that day. Maybe had some good sex with the wife or the husband before and is happy to put a stamp on it and transfer the money back. Yeah, when they're grumpy, they can say like, oh, your statements are not sufficient. I'm not going to pay you. Yeah, it is really like that. That's why we need this law. Yeah, and this whole system coming in place in the European Union, because for me, this is one of the biggest scams in Europe. All those countries are keeping the dividends withheld, and they're just and I can see already those Christmas parties at the tax office in every country each year. Yeah, then they're drinking wine and giving each other presents, making a speech, how great they did. But it's really funded by us as dividend investors.
Yeah. They're getting rich off us not claiming our pennies back. That's what's
Yeah. They just throw some barriers up, and they know 99% of the retail investors doesn't claim it back, and they can have their annual Christmas party. I mean, that sucks.
Yeah.
But I would always say these kinds of things, do it yourself, because I think it's also important to do it yourself first, so that you know what it entails, and then think about an accountant. But if you take an accountant, make sure you have like, let's say, tens of thousands of dividends from a single country incoming. Otherwise, I think you pay more for the accountant than the dividend you will get back.
Yeah. Juan has asked us if we had €5,000 to invest and we have to put it into the stock market tonight, what would we invest in? Otherwise, we would lose that money completely.
You go first.
Realty income.
Realty income? You became fan, right? You did a video about it.
Yeah. I mean, they're trading really, really attractively. I know Agree Realty is probably one of my favorites, but their share price is a little bit stretched for me. I think Realty Income in terms of its price, its dividend yield is close to 6%, and they give you dividends every month. So who doesn't want that? So yes, I am a fanboy right now. I'm liking them at this price, so I would pick them.
Yeah. It's a bit of a difficult one for me, but if I had 5,000 euros, taking the currency risk into consideration, I will probably buy some Iberdrola.
Okay.
And there's a question about that later.
Yeah, we'll get to that. Yeah. Connor has asked us about being caught in the blast zone. He says it is not ideal. It's inevitable that insurers in Europe will get hit more frequently from claims arising from climate change, such as those that happen in California. So I'm assuming this means like some of these fires and all this that has been going on in America. Is this a concern of yours considering the weight of such companies we have in our portfolio?
No, not at all, because my the weight of my the companies in my portfolio are mostly around life insurance, and life insurance is also kind of a semi-scam. But it's like tobacco; you earn a lot from it. So, and actually, if there will be a lot of flooding, people would die earlier than the life expectancy. So the rewards go up for the insurance companies that I'm invested in. So it's kind of a win-win for me. Yeah. So the more the more, let's say, flooding in the Netherlands and everything that would happen would benefit my portfolio from that point of view. If the people die, I mean, it sounds very cruel, and maybe it's not nice to say. I guess I have with Munich RE, I have a little bit of exposure. I believe they had 1.5 billion exposed with the forest fires in California. But then again, they can, you know how it goes, right? They will just charge much more next time, yeah, for this, and they will just pull a leg from those people living in those areas, or just not insure them at all.
Yeah.
I mean, this is why, like, in my opinion, every stock is a sin stock. Yeah, with ASR and N Group, you're in life insurance. They benefit from people dying earlier. Yeah, because then they keep the money. Yeah, they don't want them to go beyond the life expectancy. And it's actually quite cruel business that you're there calculating already, like, okay, when will this person die? Yeah. That's kind of what it comes down to. Like, you're sitting there, and probably the insurance salesman sits in front of you, is just staring at you, feeling like, is this guy going to become 70 or 75? It's just all the time. And based on that, you do business. I mean, how cruel is that? Yeah.
That's how they make their money, though. That's imagine that. Imagine that's your job. That's your job to predict that. How
Yeah.
morbid is that?
Yeah, yeah. And then you're just asking, like, do you smoke?
To smoke? Yes.
Do you walk? Do you eat meat? Where do you live? Oh, so you expect to live long? Okay, well then I'll charge you more.
Yeah, yeah, yeah.
Yeah,
That's
no, so I don't. I think insurance companies have this benefit, actually, and that's why they have this solvency ratio. If you look at Munich RE, that has some exposure to this kind of stuff, right? It has a solvency ratio of 270%. So I think, Connor, I think it's really about knowing what insurers you own and what products they have in their portfolio. Yeah. So Allianz has, for instance, quite some asset management in there. And if I think about Munich RE, Allianz, and then Group and ASR that I have in my portfolio, I feel actually a little bit the most uncomfortable with the asset management part of Allianz. Also because of the liability they had the other time with the teachers fund in America. So, but no, honestly, Connor, not that. Maybe I'm having a blind spot there, but no, I just see it more as opportunities. The more, sorry to say, really sorry, because it's cruel for the people living there, but kind of the more fires will do this company well.
Hussein has asked us, are we reading the ESG sustainability part of annual reports?
Yeah. I read them from the bottom up and from the right to the left.
That's a no.
I mean, I was even wondering, like, does anyone ever read it? I think they're writing this for activists. I can't even imagine that a pension fund is reading those. I mean, why would anyone read that?
I don't know. I always skip just straight past it. So
Yeah, and I like what he says. Why an insurance company spend 30 to 40 pages for ESG and put carbon emissions targets while not producing a single thing? ESG looks to me a tool to reduce profit margin, but maybe I'm missing something. I just think it's greenwashing in the end. That's really, really what I think. It's just like to satisfy, I don't know, an ESG rating, whatever.
yeah,
I
look, at least the insurance companies are meeting their carbon emission targets.
Where can I bang my head? No, but for me, I mean, writing a report, you need to know, right? Either it costs paper, glossy paper, which is probably not from an ecology point of view the right thing to do, and it creates space on the internet. So also there again, but worst of it, they probably have consultancy companies for that charge you tens, hundreds of thousands euros to create this for you. I would I would just cut this out straight away. Yeah, I think you're not ESG by writing a report. You're ESG by your culture and your behavior. And I think having an ESG approach in your company, it's generally a good thing, I believe. But let me explain my philosophy. I strongly believe that if, for instance, you invest in the ecology of it, that you need less and therefore produce more efficiently. Yeah. So if it's around those kinds of things, I think you're just more sustainable set up with your business. But if it becomes to wokeness, yeah, then you have this quote, woke, go broke. But if you can reduce, let's say, the plastic on your products by 40% and still do the same packaging, that's a good thing to do.
Yeah.
Yeah. And I strongly believe having diverse teams lead to higher performance. It's a good thing to do. Yeah, you don't want groupthink in the teams. You don't want 10 bald blokes all thinking alike. You don't create high-performing teams with that. So I think these are just good things to do. And I think high-performing companies, they have this kind of, by definition, a little bit in that. Why write a glossy 30, 40 pages about it and do some window dressing to some activists?
Who knows? Who knows? But not something that I read anyway. So hopefully somebody reads it.
But what's your thought about this? I'm now very curious.
Yeah, for me, I'm quite similar. I'm quite similar to you in that you're not ESG, as you said, by writing a report. I mean, who are you writing that to? I do agree that cutting down carbon emissions is important. Okay, and I'm fully supportive of that. But like I said, for me as an investment, I'm not going to invest in a company because they're reducing their carbon emissions. It's just something as a byproduct that the company do if they're operationally doing things correctly and trying to reduce. Because if they reduce carbon emissions, probably they are doing things more operationally efficient as well.
Exactly. And that should be the driver.
Exactly. And that's what I'm more interested in, more so than carbon emissions. So
exactly.
Yeah. Miroslav has asked us about our smallest positions and how do we treat them. So some of my smallest positions are some of these investment trusts. So I have Murray International Trust is one of them. Siemens is actually quite low in terms of the number of shares that I own. How do I treat them? In the past, I had companies like Verizon, I had 1 or 2 shares of. I had other companies that I'd buy 1 or 2 shares of that I want to look at, and I just end up selling them. If I have no long-term conviction, I end up selling them. Siemens, I have a long-term conviction. I just want to buy them at a better price. And Murray International Trust is similar. I do like them. It's just after I bought them, they've increased in price above what I want. So I just holding on to them for the moment.
So I'm just checking my lowest position is LVMH because I've got 1 share in there.
Yeah.
And there's one thing that I have. In my low positions, I don't want to be concerned about those stocks. Yeah, so if it's like in the bottom 10%, this is not a stock that you are concerned about. So let's say, because it's not worth your time. You understand what I mean? So if you're concerned, I don't know, about Alibaba and the Chinese government.
Yeah.
Well, if that's your lowest stock, get rid of it. It's not worth your time to be concerned about it. But other than that, I treat them all similar. I respect them. It's a piece of ownership. They pay me dividends. So why not? And LVMH, I bought 1 share to just get into it, to start really tracking it in my sheet as well. And I would love to buy more of it. So, yeah.
Mike has asked you specifically, have you considered hedging down your payments on your mortgage with European defense stocks?
Yeah, so he's asking this because I'm not paying down my mortgage. I'm not feeling very comfortable with the geopolitical situation, living in Poland. And therefore I prefer to just invest because this money is liquid. And when it's in brick and mortar, I can't do anything with it. And if ever something would happen here and my house would be impacted, then there you are, right? So But having it hedged with defense stock, I wish I thought about it a year ago.
Yeah, hindsight is 2020.
Exactly. Maybe in the future. Maybe in the future if things calm down again.
Yannick has said that they never usually sell stocks, but they have a stock that is 220% in the plus, and its dividend yield has gone down to 1.1%. The stock is also well above its historical PE ratio. Would you sell and deploy money elsewhere, or stick with it and accept the share price might never revert to its mean?
Yeah, it's very difficult. Generally, keep my runners. I keep my winners run generally.
Yeah.
But in the end, it comes back to conviction. If you have small, low conviction in the stock anyway, it may be wise just to take the profit. And nobody ever got poor of taking a profit either. Yeah.
Yeah.
But for me, also there is always capital gains tax when I sell something. So, for instance, if I would sell my Microsoft, that would be a large bill. Yeah. There. But I believe that Microsoft 10 years from now will be much better again from where it is today, and that the dividend continues hiking. I mean, my yield on cost, on Microsoft, just as an example, is where is it? 7.3%, while the actual yield is 0.8%. Yeah, I bought it for the dividend. It has been doing everything what I expected and even more. The dividend continued growing. It's just share price went really up. Now, I did sell some Apple. And why did I sell some Apple? Because I see flat earnings growth already for 3-4 years. And then I see the stock price just exploding because I guess it's part of the Max 7. And here I thought like, no, let's start trimming. The yield is 0.4%. And I see that they don't really prioritize the dividends. So I felt like, okay, it doesn't need to be such a large position in my portfolio. And I can, in this case, buy some, I don't know, an insurance stock for it at 5 or 6%. So that's what I've done with that money. But that was the first time, I think, in my entire 14 years that I sold a winner well, no, I did McDonald's. And that's why I learned that I shouldn't do it. And I did McDonald's after 3 or 4 years. So yeah, probably in the first time in a decade that I did this now.
Yeah.
It was a very special situation, and I've been thinking very long about that. But the earnings from Apple are just not going anywhere, and the price just continued to climb and climb and climb.
Yeah, I kind of agree with that sentiment. I learned that with Microsoft. I think everybody learns it at some point. But remember, I know Yannick has said the dividend yield has gone down to 1.1%, but that's not your dividend yield. Your dividend yield is what you bought it at, which is probably, if it's 200%, it's probably 3 or 4%, I would imagine.
Yeah.
So yeah, it's hard to say whether to stick with it or not. It depends on your long-term conviction. But my experience when I sold my winners, they kept on winning, and I was the only loser. That's my experience.
Yeah.
Martin has asked, how do you judge a company with their depth in your valuation? He has his own scorecard, and there's some wonderful dividend companies that score lower because of their depth. And an example of this is Home Depot, John Deere, Target, Hershey's. So how do you handle this?
Well, yeah, it's Martijn. It's more part of our dividend safety rating that we have with the Dividend Talk Premium service, and depth is an important part of that. So it's not so much in the valuation itself; it's more in the dividend safety rating. And in the valuation, you need to think that the free cash flow kind of covers that already. So it's already built into that, and you don't want to account for it twice. So, yeah.
Kieran has asked me my favorite thing to buy at Greg's, and Greg's sell pastries, but there's one called sausage and bean pastries, a pie, and it sounds horrible. And I remember the first time someone told me to try it, I was like, I'm not going to like this, but it was amazing. That's the first thing I always buy when I land in Greg's around in the morning. First thing I buy is a sausage and bean pie. Now on to some stock questions, and Mayak has asked us about Target. And first question is, have you ever been to a Target store? He's trying to figure out what store in Europe it can be compared to.
Yeah. So yes, I've been. For me, they are a little bit like those French supermarché stores because
Yeah,
they have this whole clothes department and everything as well, where people are buying clothes.
yeah.
It's not your, it's not an Ahold, to be
No,
clear.
no. It's more like Carrefour. Carrefour is the
Yes, yes, but in Poland, Carrefour, at least where I live, doesn't have such a whole department with clothes and all these kinds of goods. A little bit, but I think the super big ones they have that.
yeah.
Yeah,
Tesco's have. So if you ever
yeah,
been to Tesco
hmm,
in the UK, they actually have their own clothing brand as well. So they
yeah,
have F&F, but it's a little bit like that, just on a much
yeah,
larger scale. Any of the targets I have been in have been absolutely humongous. They're really
yeah.
huge. And the second part to this question is management is expecting 15 billion in sales growth over the next 5 years. It's 14% growth from 2004 with 2.8% CAGR. This is not as much as the last 5 years, which had a CAGR of 6.4%. So sales are going to go down. What do you think about this?
Yeah, I wouldn't look too much at the 6.4 number, CAGR, because we had super hyperinflation. Well, maybe not hyper, but super inflation. Remember the 10%, 15% inflation,
Yeah,
which was also in their cost base. So you need to really look at the profitability and the operating margin. So you need to figure out from this 15 billion sales, how much will really trickle down to the earnings. And I think that's more important to look at. I haven't really done my due diligence yet on that, so I can't tell you what I particularly think about it. But this is just a slow compounder, and anyone thinking just because of COVID that suddenly we would see double-digit growth, it's a little bit. mm, I mean, yeah, I don't see that. It's
yeah,
a slow compounder. What they did, so what I like about Target, it was I think 6, 8 years ago, they were in trouble a bit, and then they did this all store remodeling, and that's when they had some really good growth again. Became much more popular again. So this company Target is really good in continuously evolving, and that's what gives me a lot of confidence with Target.
yeah. Dividend check has asked us about Iberdrola. So one of the concerns is that he doesn't like is that the nuclear plants in Spain will soon have to shut down. This could lead to lower earnings and possibly a dividend cut. What do you think about that?
Yeah, I think you need. They don't have too much nuclear exposure. They have been already reducing that exposure for quite some time, for many years, uh, because it went more into renewables. So, if I remember correctly, they previously owned stakes in several nuclear plants in Spain. I believe they had had a share in Confrentes nuclear power plant at the time, but over the years, there's been just decreasing its stake in those things. So they've been decommissioning, they've been doing asset sales. It sold its 50% stake in Santa Maria nuclear power plant, if I remember correctly. So I really believe that the exposure is not so big as he may think it is. But Sebastian, if you have some counter arguments or proof, let me know. But from what I see, I think Iberdrola shifted away already from that. So yes, it has some historical involvement still with nuclear power, mainly via its stakes in some of the Spanish plants, but I would say it is relatively minimal and decreasing. So that's my thinking based on data I saw. Of course, disclaimer that I may be wrong, but that's what that's my thoughts based on all that I've read about Iberdrola.
Yep. What about T Rowe price? Nick is asking us about the 15% drop in share price, and it might be a buying opportunity. It's its assets under management outgoings is only 1.5%. So what do you think?
Yeah, I mean, I was hoping, of course, a little bit more for proper dividend growth with T Rowe price, but still a spotless balance sheet. Assets under management are slightly declining. They need to fix that. Is the buying opportunity? I mean, it's hard to say. If you would have asked me 2, 3 years ago, definitely. If you ask me today, well, there's not a lot of schwung in the company either. Yeah, but hey, spotless balance sheet, profitable, good dividend cover. So if you are patient and you believe that management finds a path to compete with the lower index funds and able to also, grow its participation from pension plans and everything, then this might be an interesting yield to consider. But
Yeah.
that's I mean, I know Nick a little bit from Twitter and such, and but I don't like to give stock advice and such either, and that's not my job to do.
Yeah, it's a tough one because you look at the likes of Blackstone, BlackRock, even KKR, they've all done really well over the last couple of years, and T. Rowe Price are struggling a little bit. There's a concern about the growth and how they're going to transition into ETFs or how they're going to disrupt themselves. So it's hard to know. But as you said, pristine balance sheet, which lets me sleep well at night in terms of the position I hold. But I'm not adding any more. That's my
No, I've got several thousands in it, and it's enough. Yeah.
Yedia has asked us about our thoughts on CNQ, so Canadian Natural Resources, after their earnings report and modest dividend hike. It's not a company that I follow completely, I have to be honest. I know we get asked this question quite a lot, but I don't have too many Canadian stocks on my radar. I assume you probably don't follow them either.
No.
So I don't have a lot to say. I browsed over their press release. They look quite positive. They say they generate a lot of free cash flow. Looks like sales were up in terms of crude oil, both quarterly and annually. So it looks like they did quite well, but I don't know what their future growth
Can you
is.
do a dividend stock card on that for premium subscribers? Because I think it's a bit of a favorite.
Yeah, I can look at that at some point.
Yeah. But beware of the currency risk. It's Canadian. Tariffs.
It's Canadian, 15%, 25% tariffs.
Well, maybe it's postponed by a month. Who knows?
Yes. Uranium Bull has asked about Greencoat UK wind earnings. Does everything seem okay? I don't know. Did you get a chance to look at it?
I looked at it a bit, and it's. I mean, to be fair, I didn't read everything. I skimmed through it. On the surface, it looked okay. The price, of course, has been going down quite significantly from Greencoat UK Wind over the last months, right? So I think I bought for the first time at 160 or 150. Now it's, I don't know, I don't have it in front of me, 125, 121, something like that.
Yeah, I think so. Yeah, around that.
Yeah. So look at that. Yeah. What is it, 8-9% yield now?
Yeah, it's quite high. But I mean, I looked at these earnings a little bit, and I think the NAV dropped around 8.5%, which is quite high.
Yeah.
Price forecasting was over ambitious. I know. I mean, look, the Ukraine war kind of increased prices over the last couple of years. That's kind of starting to soften in the UK. And also wind. I mean, wind is wind. You can't predict what the wind is going to be. So they didn't generate as much as they predicted, and it cost less, or they're getting less. So it was kind of a bit of a double whammy. They did refinance a lot of debt on their balance sheet. They've pushed that out. They have initiated a buyback program, I believe, of 100 million.
I can imagine.
And they have also increased the dividend by 10%. And remember, they usually increase the dividends in line with inflation as well. So,
but if you can buy back, dividend, if you can buy back your shares that have a cost of capital because of the dividend of 9 to 10%.
Yeah,
I mean, that's what they keep in the pocket, right? With every share they retire, it's 9% yield that they are retiring.
Yeah.
I mean, if you have the cash left, it's I would say that's smart buybacks. Yeah.
But remember, I said at the start of the year that they're trading at a huge discount. You mentioned it, that they've been dropping in price, so that discount is getting wider and wider. What that means is that every year there's an annual meeting and they have to vote on continuation. This year, 11% of shareholders voted to shut down UK Wind, right? Only 11%. Now, what that means is they have to vote on this again next year. So it's just something to be aware of. There is always that danger that they could wind up because investors are not happy, the returns are not good enough, or they feel like it would be better if someone else bought them out. So there's always that risk with this type of company. But look, let's
wind up as a good description for them.
Wind up, wind up, yes. And also management is changing, and management is really important in
Yeah.
investment trusts. I don't know a lot about, I think it's Matt Ridley and Stephen Packwood taking over, from what I remember, but I haven't read into their history or what they do. So that's something I need to
Yeah.
look at as well. But yeah, they've been dropping a lot since I bought them. I'm still heavily bullish on renewables. I do like wind, even as unpredictable it is.
Yeah.
But let's see. Let's see.
And maybe we can see if they would like to be one time on the show.
Yes,
Why don't we do a cold call to them?
we could ask. I know investment managers go on to Moneymakers, which is a podcast I listen to. So I don't see why they wouldn't come on this. We could ask. Daniel has asked us about Financial Times investigation into Brookfield. The Brookfield Corporation is quite difficult to understand at times. There's a lot of subsidiaries, a lot of stuff going on. But this article is kind of highlighting that it is selling billions of dollars worth of property from one part of its company to try and prop up another part of its insurance part of its company. And this kind of circular transactions is not really transparent, and maybe leading investors or leading people to believe that Brookfield are doing better than what they are doing. And do you know what? Brookfield is quite a difficult company to understand. I looked at Brookfield Corporation briefly, and also Brookfield Asset Management, which is one subsidiary. But honestly, to understand the whole structure of it, you need to have some sort of degree in financial accounting and business or something. It is quite difficult to understand. So
But this company always sounds like, when I hear you guys talking Brookfield and asset management, it always sounds so good, right?
yeah,
15% growth, 15% growth. How, I mean, we had Enron scandal and everything. I
yeah.
kind of, we're ready for another scandal, right?
I mean, there's no smoke without fire, and for the Financial Times to highlight these kind of circular transactions within a company like this, it is a little bit concerning. We do know that their insurance part of the business is not performing as well as the other parts. Now, what the Brookfield want to do, they want to probably prop this up. They want to show that they're a healthy company, that all their subsidiaries are firing on all cylinders. So it's not beyond the realms of possibility that they are doing this, I have to say. And given the complex structure of it, I think it would be difficult for a retail investor like me to even spot this.
Yeah.
If I'm honest.
Yeah. Well, I don't own it, so for me, it's more like these stories are a little bit more like popcorn time.
Yeah. Well, I do own BAM, the asset management part, which is heavily linked into the assets owned by Brookfield Corporation, which is the parent company. So this would have a big impact on me if that was the case. So it's something I have to look at and pay attention to.
Well, we always say you can't borrow convictions, so will you then study it better, this risk?
I will have to study Brookfield Corporation better than Brookfield Asset Management. I'll have to understand. And if it sits on the too hard pile, I'll have to consider moving to something else.
I mean, the issue is with this is really hard because I had one time ARCP in the beginning of my investment career. There was a real estate investment trust, and they were cooking the books. Yeah, but it's hard to discover that because you're reading annual report or something like that. You trust the data. But if they've been lying about the data, and then from time to time you can do all the homework you do. From time to time it happens. Ahold had the booking scandal in the early 2000s. Shell one time had an issue with their oil reserves in the books. These things happen. Yeah, these things happen. So I think that's why, again, another thing is like diversification, and many people get burnt on from time to time on this. And ARCP, you know what ended up with it?
No.
It became VRight. It changed its name after that because, of course, ARCP was all over Google as a fraud. And guess who bought VRight?
Who?
Realty Income. Remember that a few years ago?
Yes, of course, yes. So
yes. So hey, that's the fun thing when you're investing for over a decade. You remember all this kind of stuff. So I remember ARCP. They had like a 7-8% yield. I sold them with a small loss. And I felt like never ever again. Then it turned into VRite. I felt like, oh my God. Yeah, they're just changing the name to so people, retail investors and other investors are buying it again. And then on a certain day, I read like Realty Income is taking over VRite.
I
And
remember.
oh my God. Yeah. It's like it just wants me. Yeah.
Yeah. But part of my problem here with Brookfield is that the Financial Times have no incentive to go out and write an article like this. They don't.
Of course, they want to sell papers. So
Yeah,
juicy.
they have to sell papers, but there has to be some facts behind it. So
Yeah, that's true.
it's quite concerning. It's not like it's someone on social media trying to gain some traction or some individual report.
Ooh.
So it's so it actually does concern me a little bit.
Yeah.
Anyway,
Okay. Well, I hope you sleep well at night tonight.
I will. Trust me, I will. Kevin, so I think we spoke about dominoes over the last 2 episodes. They've kind of popped up, and maybe Buffett having a position in them is highlighting this. But he's asking, do you see their stores popping up in Poland and their drivers flying around in their Vespas? Are they becoming successful in that area, in your opinion?
So we have one in the neighborhood not too far away. Locals are going there. I don't see them driving around. We have so many Italian restaurants and pizzerias here. So I don't know about you. I would never go to a Domino's if I can get one at the Italian pizzeria.
No, I'm just saying we have Domino's and an Italian pizza within 2-minute walk.
Yeah,
Italian all the time.
and I don't think Americans necessarily understand this culture. You want to buy a pizza from a guy called Mario, and we discussed this, right? So I'm biased there. I can imagine in more the urban areas, like in Warsaw, very dense, that between all those big blocks and buildings, and you have a good delivery there, quick delivery. I can imagine that people would opt for Domino's.
Yeah,
but if you have just enough time, I mean, why would you go to Domino's if you can get it from the local Mario or Geppetto or whoever they are called?
there's a place in Bologna we go to called Nicola's Pizza. It is amazing. We go there every time. Like if I go for a week, I have to go there at least once. The pizzas are good, and the limoncello is not bad either. Limoncello. Keep Walking has asked you about your opinion on Remy Contrero and Porsche Holdings.
Yeah, so I would need to look into this. Keep Walking, and Remy Contrero is this. I think they produce this drink. That you can use in the nice cocktails, right? Here, is it the margarita that you put it in? I think is it in the margarita where you put it?
Yeah,
I believe so. Yeah. So it's an alcohol stock, and but I do know that I looked into it like 3 or 4 weeks ago, very briefly, but I don't remember anymore what my thoughts were. I need to check my notes. And then Porsche, yeah, I don't invest in car manufacturers at all.
Yeah, I think something popped up on my timeline about Porsche having to write off 2.1 billion, something with Volkswagen. Anyways, Volkswagen have to be involved, of course, because they love being involved in controversy. But yeah, I tend to stay away from cars as well.
Me too.
And there was one question from David asking us about Svenberg Group. He mentions that it doesn't meet our criteria when it comes to dividend history, but nonetheless, I think it's worth a look. I don't know.
I've never looked into it. No,
I have so many companies on my list that if it's not going to meet my dividend history, I probably will not get to it. Although I will say, I did a deep dive on Games Workshop. Yeah, I was really. It doesn't meet my criteria in dividend either, but I was quite impressed by that company. So maybe I need to broaden my horizons. But yeah, we haven't got time to look into that, David. Sorry. Okay, that is the end of the show. A little bit shorter than last week, so we apologize to all our long distance runners. But thank you for listening. Thank you for all the questions, and we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just two guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.